Top 10 Notes from the Tao of Warren Buffett, Part 2. Note 11. Recommending something to be held for 30 years is a level of self-sacrifice you will rarely see in a monastery, let alone a brokerage house. Your stockbroker would starve to death before he would adopt Warren's strategy of buy and hold. It's not that brokers believe it will create wealth, it is just that it won't create any wealth for your broker. They make all their money on the commissions they receive by getting you into and out of stocks. If your broker has more than one great idea a year, the odds are good he is delusional. If your broker wants to sell you out of the position that he put you into last month because the market conditions have changed, he might be little more than delusional. He might just be dishonest. Note 12. There seems to be some perverse human characteristic that likes to make easy things difficult. Wall Street is in the business of selling its expertise in picking stocks for you to invest in, and because of this, brokers have a vested interest in presenting the investment game as being so complicated that it is beyond understanding for anyone but the most savvy of pros. Their scheme is simple. They are going to get rich off making you rich, and they keep you coming back because they have convinced you that the investment game is too complicated to figure out. Note 13. The business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. Medieval English philosopher and Franciscan monk William of Ockham, affectionately known in some scientific circles as Billy Ockham, put forth the idea that the simplest explanation is usually the best explanation if you understand the investment process. There would be no need for investment analysts and advisors, nor would we need mutual funds or any of the other priests of the profession. Finding a great business and buying it at a great price and then holding it for 20 years is not that hard to learn and profit from when all the so-called priests of Wall Street are preaching short-term investment strategies, which, in truth, are completely geared for making the advisor, and not the advisee, rich. Note 14. Diversification is protection against ignorance. It makes very little sense for those who know what they are doing. If you don't understand what you are doing, you should broadly diversify your investments, with the hope that not all your eggs will go bad. If your investment advisor recommends broad diversification, he is really telling you that he does not know what he is doing and he wants to protect you from his ignorance. Warren knows what he is doing, so he prefers to concentrate his investments on a few well-chosen eggs, and then he watches them like a hawk. Note 15. I've never swung at a ball while it's still in the pitcher's glove. Warren has long been a student and fan of baseball, and he took an important ingredient for his investing strategy from a book that superhitter Ted Williams wrote, entitled The Science of Hitting. Ted argues that to become a great hitter you have to keep yourself from swinging at bad pitches. What you are looking for is the perfect pitch. Warren took it as an analogy to investing. To be a great investor, he only had to wait for the right opportunity. He also realized that unlike Ted, who was only allowed 3 strikes, he could stand at the plate all day waiting for the perfect investment opportunity to appear. Thus, Warren never buys into a company if he can't gauge how the company will perform in the future. He likes great business with predictable future that is selling at a discounted price that was brought on by a correctable mistake by management or an industry recession or a bear market. Note 16. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. Remember, when prices are in the sky, it's time to say goodbye, but when prices fall, it's time to give your broker a call. During a bull market, people are being greedy and are driving stock prices higher and higher, which attracts more and more people to the game. During these times, Warren is fearful and stays away from the market. It's during the bear market that other investors are fearful because no one wants to own any stocks. They sell like crazy, without any regard for the long-term economic worth of the underlying business. At times like these, Warren is in the market being greedy, buying all the fantastic businesses that he has always dreamed of owning. Note 17. We don't go into companies with the thought of effecting a lot of changes. That does not work in investing than it does in marriages. Warren has found that the underlying economics of the business remain constant regardless of the manager in charge. A great business will produce great results regardless of who is in charge, and a poor business will produce mediocre results with even the best manager at its helm. Over the last 100 years, Coca-Cola has gone through dozens of managers, some great and some not so great, yet it remains a wonderful business. However, the auto manufacturers and airlines remain troubled decades after decade in spite of all the brilliant managers who have been in charge. When investing, you choose the great business and avoid the poor business, even if it is being run by a genius. Note 18. At the beginning, prices are driven by fundamentals, and at some point speculation drives them. It's the old story, what the wise man does in the beginning, the fool does in the end. A wise man buys when the fundamentals are in his favor, That way he has a margin of safety as to how low the prices can go. Time is also the friend of the fundamentals in that all prices eventually correct themselves to reflect the fundamental long-term economic value of the business as measured by what it will earn. When speculation steps in, fundamentals are thrown out the window and rising price motivates more and more buying. A savvy investor knows that at some point in time the only real demand is fundamental demand. And when the speculation demand ends, and it always ends, the price will fall back to reflect the fundamental demand, which is sometimes a long way down from the speculative highs. If you are speculating and are still holding positions when prices start to fall, you only need to look in the mirror to find the fool. Note 19. I never attempt to make money on the stock market. I buy on the assumption that they could close market the next day and not reopen it for 5 years. Warren is buying on the assumption that he is buying into a business. The stock market sometimes allows him to do this at a cost below what the whole business would sell for to a private buyer. Warren isn't playing the stock market, but rather institutions that are so short-sighted that they are willing to ignore a company's long-term economics in the never-ending search for the quick buck. The glory of being named top mutual fund of the year. If you buy the right company at the right price, the only thing time does is increase the value of the business, which makes you richer and richer and richer as the stock price increases to reflect the underlying value of the business. But get this, if the stock market closed for 5 years, the underlying value of the business would still increase. Note 20. Uncertainty is actually the friend of the buyer of long-term values. Uncertainty in the stock market creates fear, and fear creates panic selling, which forces prices downward regardless of a business's long-term economic prospects. This chain reaction creates a buying opportunity if the long-term economic value of the business is in excess of its selling price. Thank you for watching. Don't forget to leave a like and subscribe for more content.